Large-scale urban development and infrastructure projects aren't built on cash reserves. They rely on the issuance of bonds to aggregate the sums of capital required to move from a blueprint to a finished skyline. A bond is a debt contract with a specific anatomy. It features a face value, which is the amount repaid to the lender, a maturity date, marking the end of the loan, and a coupon rate, representing the periodic payments made to the investor throughout the term. Once a standard bond is issued, these figures are fixed. The contract is a static agreement locked in at the moment of issuance. However, the financial environment is not static. Central banks adjust interest rates, like the overnight policy rate in Malaysia, and inflation shifts the purchasing power of the currency over time. Because a rigid contract can become a liability when economic conditions change, the market developed a toolkit of specialized bonds designed to manage that shifting risk. The foundation of this toolkit is the government bond. National governments issue these to fund public spending, and because they are backed by the state's ability to tax, they serve as the low-risk anchor of the global financial system. This infographic categorizes securities by maturity: short-term treasury bills under a year, treasury notes for 2 to 10, and treasury bonds up to 30 years. In Malaysia, the government issues MGS and Islamic Government Investment Issues, GII. These bonds are highly liquid and transparent, but their safety creates a specific trade-off. They offer lower yields than riskier debt, meaning their returns can struggle to stay ahead of inflation. While government debt provides stability, investors seeking returns that outpace inflation must look toward tools with higher risk and more complex structures. Corporate bonds provide the capital for private expansion, such as Petronas issuing debt to build a new LNG terminal. Unlike governments, corporations face the possibility of default, which changes the profile of the investment. To attract investors to this higher credit risk, corporate issuers must offer higher yields than sovereign bonds. To manage their own exposure, corporations often include embedded options, mechanisms that allow the bond's terms to change before it reaches maturity. A callable bond allows the issuer to buy back debt early. In 2022, Maybank issued Tier 2 bonds with this feature. If market rates drop below the bond's coupon, the bank calls the bond, paying off the investor early to reborrow at a lower cost. Conversely, convertible bonds give the investor an option. They can choose to trade their fixed income debt for company equity shares, providing a path to profit if the company's stock price rises. These structural options allow both the borrower and the lender to adjust their positions as market conditions evolve. The toolkit is expanding to include ethical mandates, like green bonds and sukuk. These fund sustainable projects while adhering to specific investment criteria. Issuances like Khazanah's SRI sukuk and Tenaga Nasional Berhad's green sukuk fund renewable energy infrastructure, using profit-sharing or leasing structures rather than conventional interest. Because even these non-interest instruments must remain competitive with market benchmarks, they all follow the same inverse relationship. When market interest rates rise, the price of existing bonds and sukuk falls. A bond's specific structure determines how sensitive it is to these changes. Bonds with longer maturities and lower coupons generally experience the sharpest price movements when rates shift. This means a bond's market price is a mathematical result of its internal characteristics reacting to the external economy. Since market rates are always moving, bonds rarely trade at their exact face value on the secondary market. Instead, they trade at a premium or a discount to reflect their relative value. To find the true annual return, investors use yield to maturity, or YTM. This metric factors in the current market price, the time left until maturity, and the remaining coupon payments. YTM standardizes the comparison between different bonds. It allows an investor to weigh the value of a high-yield corporate bond against the stability of a government security on a level playing field. By identifying these structural features, an investor can see how economic changes translate into specific price movements. This reveals the underlying math that governs the movement of capital between borrowers and lenders.